Students, let us come to chapter recording of transactions. Now students, let us understand first what is a transaction. We use this term very often. Now, transactions involve exchange of economic consideration between the two parties. Now, it has some very important aspects to it. It involves exchange of economic consideration between the parties. That means exchange of things of value between two individuals. Let us take an example to actually illustrate this point. You purchased a book for rupees 200. Now student, when you have purchased a book for rupees 200, there is an economic value to it, and the two parties are you and the shopkeeper, and there is a reciprocal exchange of items. And what are those two items? He gives you book and you give him money. So shopkeeper is giving you book and what you are giving him is money worth rupees 200. So there is a reciprocal exchange. It is an example of a transaction. So let us reiterate it. They are the exchanges of economic consideration between the two parties concerned. Now, every transaction must be backed by documentary proof. Since we had already done this under verifiable objective principle. As per this principle, verifiable objective principle, every transaction must be backed by some documentary proof. Now, documentary proof, it can be in the form of a bill, a memo, or pay-in slip, or vouchers, etc. These are the documents which actually support the fact that a transaction have actually taken place. Accounting vouchers. Now students, what are accounting vouchers? Accounting vouchers are source documents. They are the documents which provide documentary proof or necessary proof of a transaction having taken place. Now students, these vouchers are of various types. They can be cash vouchers, they can be debit vouchers, they can be credit vouchers, they can be transaction vouchers, or we sometimes refer to as journal vouchers, or we sometimes also refer to them as transfer vouchers. Now students, these are various forms of vouchers. Remember one thing, there is no definite format for a voucher. Every firm, every business prepares its own vouchers according to the information that it desires the vouchers to convey. But some basic characteristics are there. Now let us discuss those characteristics through various examples. I am making a small debit voucher for you. Now student, it is a debit voucher. The first characteristic that it must have is the name of the firm here. The name of your firm. Let's say you are a firm by the name of ABC Limited. So it will carry the name ABC here. Then the second important part is it must have a distinct voucher number. A distinct voucher number, and this number should be carried on in a chronological manner. the first voucher, the second voucher, third voucher, and so on. It must be duly dated. Then it must have details of the accounts to be debited. Which account to be debited? With certain narration. This is narration part. By narration we mean the explanation of that transaction. Why this voucher was prepared. Over here we write amount in rupees and this is the total. Now the voucher must be duly signed by the person who has prepared it. Usually it is the accountant. So it must be signed by the accountant and it must be countersigned by some senior authority, a manager or a head cashier or anybody else who is authorized to do so. So what are the basic characteristics? The first one being the name should be there. The second one is the voucher number. The third one being that it must be duly dated. It must have clear mention of the account that has been debited. It must carry narration as to why this voucher was prepared. It must have the amount and it must be duly signed. So these are some basic characteristics of a voucher. Similarly, we can prepare credit voucher also. The format usually remains same. The only thing is that the name will change. It is now a credit voucher. And instead of debit here, we will write credit. Rest every part remains same. But a transaction voucher, a journal voucher is a bit different. It has both the details, that is the debit and the credit accounts. Let us understand the format for transfer voucher as well. It has the name of the firm. So this is the name of the firm here. Voucher number. Dated. It has details of the accounts to be debited. Which account to be debited? It has the details of the account to be credited. Which account to be credited now? There is a total narration here. The amount. The amount to be debited in front of debit, the amount to be credited in front of credit, and lastly it must be duly signed by the accountant and must be countersigned by some senior manager or senior functionary. Now students, accounting equation. What is an accounting equation? Accounting equation is a statement which shows the fundamental relationship between three accounting values. It says that in any business, assets are equal to capital plus liabilities. Now let us recall what are assets, what is capital and what is liability. What are assets? Assets are things of value owned by a business. Things of value owned by a business. Assets represent the economic resources of a business. I'll write it here. They are economic resources. Now students, coming to capital. What is capital? Capital is the claim of the owners. It is the amount which has been invested by the owners in the business. Then what are liabilities? They are the claims of the outsiders. Now let us take some examples. Liabilities are claims of outsiders, so they include bank loans, creditors, etc. Assets, they are economic resources. They include cash, bank, stock, etc. So now what accounting equation says is that whatever the resources are there in the business, these resources are a sum total of the money invested by the owner and the money that the business has borrowed from the outsiders. This accounting equation also illustrates the double entry concept. Now students, it illustrates double entry concepts. Double entry concept. Let us recall this concept as well. As per this concept, every transaction has two aspects and both of them should be recorded. Let us take an example to understand this concept. Now, the example I am writing here, capital brought in by Ram. Ram is the owner. I am specifying it here, rupees 5 lakh. Now students, Ram is the owner of a business who has brought in a capital of rupees 5 lakh in this particular business. So how will you illustrate this using accounting equation? Let us actually try and analyze this transaction and find out two different items. Now remember, whatever are the accounts or whatever is the effect must be actually seen or valued from the point of view of business. Now the point of view is of business. From the point of view of business, we are getting cash. Cash is an asset, so I am writing it directly under the head of assets. Business has got assets worth rupees 5 lakh now, and this 5 lakh has been brought in by the owner. So owner's money is represented by capital. I am directly writing it under capital, 5 lakh. And you can see that they are always equal as there is no component of outside liabilities. So now students, it makes it very clear that in any business, this fundamental relationship holds true at any given moment of time. That is, the assets at that moment of time is the sum total of capital and liabilities at that particular time. Now students, let us prepare accounting equation from these transactions. The transactions are given here. The first one being started business with cash, rupees 5 lakhs. Purchase goods on credit, rupees 60,000. The third one being paid wages, rupees 10,000. And the last one being purchase goods for cash, rupees 20,000. Now students, before we start solving it, let us reiterate that the point of view that we are going to consider here is the view from the business. That is, the effect of these transactions should be from the point of view of business. So I'm just writing it here for your convenience sake. Point of view of business should be considered. Of business. Now students, let us understand first transaction. Started business with cash. Now, started business with cash. From the point of view of business, there are two effects that are there in this transaction. The first one being that the owner is bringing cash. Now, cash is an asset, we know it has certain value. So, in asset column, we'll create a separate column for cash. Cash, the business has received cash worth rupees 5 lakhs. Now, this is the first aspect. We know that dual aspect principle says that there must be a second aspect also. Now the second aspect is that the business has been started by owner. Now the owner's money is represented through capital. So let us enter this 5 lakh here as well. So that clears the double entry concept, that the owner is bringing in a cash of rupees 5 lakh. Since the owner is bringing, his capital has increased by 5 lakh and business has received an asset in the form of cash worth rupees 5 lakh. Now students, coming to the second transaction, purchased goods on credit. We have purchased goods on credit. Now goods are our assets. You can mention them as stock as well. So what will be the effect? Since we have purchased it, we are getting an asset in the form of stock, or in some cases you might write it as goods also. Since the business is getting assets worth rupees 60,000, it must be added to assets but under the column of stock, since it is a separate class of assets. Now these goods are being purchased on credit. Credit means our liabilities have increased. We have to pay this amount of 60,000 to some person from whom we have purchased these goods. So there will be a corresponding increase in our liabilities to the extent of rupees 60,000. We must mention that these are our creditors. Now students, what is the double effect of this transaction? Let us repeat it. We have purchased goods worth rupees 60,000. So there is an increase under the asset column in the category of stock by rupees 60,000, plus we have to pay an amount of 60,000. So correspondingly our liabilities have increased and they will be under the category of creditors. Once we have two transactions with us, we must total it out and check that they are equal. We will write it as new equation here. Now the new equation says that we have a cash of rupees 5 lakh and a stock of rupees 60,000. Don't add different columns together, just show them separately. We have a capital of 5 lakh and creditors to the extent of 60,000. And you can see that the total on the both sides is 5 lakh 60,000, which is equal. Now coming to the third transaction, paid wages. Obviously paid means payment in cash. Now since we are paying cash, so there will be a reduction in the amount of cash. Cash is our asset. So we must reduce this cash by rupees 10,000. So I am writing minus 10,000 under the column of cash. Now the second effect, wages are an expense for the business and the expenses would have to be paid for by the owner. Since the owner is paying it, his capital would be reduced by 10,000. So both the effects have been illustrated. The first one being that there is a reduction in the cash for rupees 10,000, and the second one being since the owner has paid, his capital would be reduced by 10,000. Now again two transactions are there. One is the new equation and the other one being the third entry that we have just done. Let us check by preparing new equation by totaling them. Now we have a cash of 4,90,000. We have assets worth rupees 60,000. We have capital of rupees 4,90,000 and liabilities still stand at rupees 60,000. Now you can see that the total on both the sides is 5,50,000. Now students, coming to the last transaction in this example, purchased goods for cash. Now we have purchased goods. Since we have purchased goods, so there must be an increase in the stock. By what amount? 25,000. We already have a column of stock. So the effect of this transaction would be that the stock will increase by 25,000. What will be the second effect? Students, it is very clear that we have paid cash. Since we have paid cash, that means there should be a corresponding decrease in the amount of cash. So let us deduct 25,000 from cash. Let us understand it again. We have purchased goods worth rupees 25,000 by paying in cash. Since we have purchased goods, there is a corresponding increase in the value of stock and a decrease in the amount of cash that we have paid. Now students, again, let us find new equation and verify whether they are equal or not. Subtracting this amount, this will be 4,65,000. This will be 85,000. This amount will be 4,90,000 and this would be 60,000. And this can be easily verified that the total on the both sides is 5,50,000. Let us prepare accounting equation for the following transactions. The first transaction is started business with cash 3,50,000 and stock 50,000. Now students, here the owner has brought in cash worth rupees 350 and stock worth rupees 50,000. That means he is bringing a total capital of rupees 4 lakh into the business, 350 in the form of cash and 50,000 in the form of stock. Then the second transaction is a simple transaction, purchase goods on credit rupees 50,000. The third transaction is sold goods costing rupees 50,000 for rupees 60,000. Now as this transaction makes it clear, goods costing rupees 50,000 have been sold for 60,000. That means there is a profit of rupees 10,000 which must be shown for in the balance sheet or in the accounting equation. Then the last transaction is paid to creditors rupees 20,000 on account. Now students, 20,000 on account. Let us understand what payment on account means. By payment on account, we understand that 20,000 have been paid now and remaining amount or the balance amount, if any, would be paid off at a later date. It does not mean that the remaining amount is discount or would not have to be paid. It means clearly that the remaining amount, whatever it is, would be paid off at a later date. So now let us come to the practical aspect of it. The first transaction is that the owner has brought in cash and stock. Now from the point of view of business, we are getting a cash of rupees 3,50,000. Cash is an asset. So let us create a column of cash and add 3,50,000 rupees. Owner is also bringing in stock. Stock is an asset. So under the column of assets, we'll create a sub column of stock and add 50,000 rupees to it. The total is 4 lakh rupees and this sum has been brought in by the owner. So owner's account is represented by capital. So add 4 lakh rupees to the capital. External liabilities are not there. So we can see that the total is 4 lakh on both the sides. Coming to the second transaction, purchase goods on credit. Now since we have purchased goods on credit, that means the business is getting goods worth rupees 50,000. Goods are our assets and they should be added to the stock. So the first effect is add the value of goods that we have purchased to stock. The second effect is that we have purchased them on credit. That means we now have a liability of rupees 50,000. Since we have purchased them on credit, we have not yet paid. Since we have not yet paid, it would be our liability and it should be written under the column of creditors. Let us total these two transactions and find out whether they are equal or not. So the new equation becomes 3,50,000 in cash, 1 lakh in stock, the capital is 4 lakh and the creditors are 50,000. It is very clear that we have total assets of 4,50,000 and capital and liabilities also equal to 4,50,000. Now students, the third transaction. Sold goods costing 50,000 for 60,000. That means goods to the extent of rupees 50,000 have been sold by the business. Since they have been sold, let us reduce the value of stock by rupees 50,000. And what we have received rupees 60,000. So this 60,000 would be added to the value of cash, since we are receiving in cash. Now in this transaction, an asset for rupees 50,000 was sold off for rupees 60,000. So there is a corresponding profit of 10,000 and profit would be added to capital. So now the new equation becomes 4,10,000 worth of cash, stock worth rupees 50,000, capital worth rupees 4,10,000 and liabilities of rupees 50,000. Now the last transaction, paid to creditor. Paid to creditor means that payment has been made, and obviously payment would be made in cash. So we will deduct 20,000 rupees from cash. Since we have made the payment, so deduct 20,000 rupees from cash. Now this payment has been made to creditors. Since this payment has been made to creditors, that means our liabilities would be reduced by rupees 20,000 rupees. So deduct 20,000 rupees from the liability column as well. And let us verify that they are equal. The new equation now becomes, we have cash of rupees 3,90,000 and stock of rupees 50,000. Our capital is worth rupees 4,10,000 and liabilities are there for rupees 30,000. It can be easily verified that the total on both the sides is 4,40,000. Now students, here the owner is bringing in cash and stock. So what will be the effect of these two entries? Now let's see, he is bringing in cash. Cash is an asset for the business. So under asset column, we will create a sub column of cash and add 2 lakh rupees here. Owner is also bringing in stock. That means under asset column, another sub column of stock, that is for rupees 1 lakh. Now in total, he is bringing 2 lakh plus 1 lakh, that is rupees 3 lakh. This 3 lakh should be entered into his capital, since this is the amount brought in by the owner. So this completes the double effect and the total is rupees 3 lakh on both the sides. Coming to the second transaction, sold goods worth rupees 20,000 for 30,000 on credit. Now students, here goods worth rupees 20,000 are being sold for rupees 30,000. That means there is a profit of rupees 10,000. And second part to be considered here is that they are being sold on credit. So now let us understand how we will deal with this. First of all, goods worth rupees 20,000 are being sold. That means goods worth rupees 20,000 are going out of the business. So deduct 20,000 rupees from the stock that we were holding. Now this 20,000 has now been deducted. They have been sold on credit. Credit means the amount has not yet been received. Since the amount has not yet been received, it cannot be entered into the cash account. So that means this amount is still receivable. Now students, debtors are the individuals from whom we have to receive money. So that means this amount of rupees 30,000 should be credited or should be entered in the column of debtors. And debtors are our assets, so it is a sub column under the category of assets. Students, in this transaction, the particular person or the owner has made a profit of rupees 10,000. So this 10,000 profit belongs to the owner, so should be added to the capital. Now once these are complete, let us find the new equation. We have cash of rupees 2 lakh. We have stock of rupees 80,000. Debtors are worth rupees 30,000 and capital is of rupees 3,10,000 and the total on both the sides is same. Coming to the third transaction, received from debtor on account rupees 20,000. Now received from debtor. Received means we have received something in cash. That means we are receiving cash of rupees 20,000. So let us add this 20,000 into the already existing cash of rupees 2 lakh rupees. So 20,000 is now added here. This cash we have received from debtors. That means debtor who had to pay us 30,000 rupees earlier will now be reduced by 20,000 that he has paid. So the double effect is reduce the debtors by 20,000 and we have received cash, so add 20,000 rupees to cash. Let us find the total and our new equation becomes 2,20,000 cash, stock worth rupees 80,000, debtors are now worth rupees 10,000 and capital 3,10,000 and the total on both the sides is rupees 3,10,000. Coming to the last transaction, rent outstanding. Now students, it is rent outstanding. Rent outstanding means the expense on account of rent has been incurred but has not yet been paid. Since this amount has not yet been paid, we cannot deduct it from cash. So what to do now? First of all, it is an expense. Let us deduct it from capital since the owner has to bear all the expenses. The second aspect would be, since this amount has not yet been paid and it is payable, so it becomes our liability and should be added under the column of liabilities as a subheading of rent outstanding. OS stands for outstanding. So now both the effects are shown. It is an expense, so deducted out of capital, and since it has not yet been paid, it is a liability. Let us total it out and check our new equation. 2,20,000 rupees cash, stock worth rupees 80,000, debtors are 10,000, capital is now 3 lakhs and rent outstanding is 10,000 and we can verify that the total on both the sides is rupees 3,10,000. Let us consider accounting equation through another example. Now students, the first transaction here is started business with cash rupees 5 lakh and building worth rupees 15 lakhs. That means the owner is bringing in cash and building. Both of these are assets, so under asset column, we will create a sub column for cash and another column for building. He is bringing in cash worth rupees 5 lakh and building worth rupees 15 lakhs. That means in total, the owner is bringing in a capital of rupees 20 lakh rupees. Now, both the sides are equal and the total is 20 lakh rupees at each end. Coming to the second transaction, purchased goods on credit. Now, the owner has purchased goods and that too on credit. Now, since he has purchased goods, that means the business will now have some stock on hand. This 20,000 rupees worth of stock we have purchased. So it is an asset. We'll create a sub column of stock under the category of assets and add 20,000 rupees. Now they have been purchased on credit. That means the amount is still payable. Since the amount is payable, it becomes a liability and would be categorized under the heading of creditors. Since we have to pay money and the individuals to whom we have to pay money are called as creditors, so we'll create creditors heading under the liability column. And the amount that will appear is 20,000 rupees. Just to remind again, we have purchased stock worth rupees 20,000. That means our assets under the category of stocks will increase by 20,000 and there will be a corresponding increase in the liabilities for rupees 20,000. 20,000. Totaling both the sides, we can check that the total is same. We have cash of rupees 5 lakh, building worth rupees 15 lakhs, stock worth rupees 20,000, capital of rupees 20 lakhs, and creditors of rupees 20,000. So the total on both the sides is 20 lakh 20,000. Now students, coming to the third transaction, paid to creditor in full settlement. Now that means what? Till now we were dealing with payment made on account. What does an account mean? Account means that the remaining balance, if there is any, would be paid on a later date. But now students, this is exactly opposite. Full settlement. Full settlement means that this is the final payment that this creditor is making, and after this, if any amount is left, would have to be considered as discount. Now in light of the above transaction, we can see that the creditor had to pay us rupees 20,000. Now he is making a payment in full settlement of 19,000. That means we have received a discount of rupees 1,000. 20,000 was payable and we have paid 19,000. So 1,000 rupees worth of discount we have received. So let us see how this would appear. Since the payment has been made of rupees 19,000, cash would be deducted to the tune of 19,000. Now students, since this is full settlement, that means what? The creditor's liability would be extinguished by complete amount. That means full 20,000 rupees would be written off of his account. And what about the balance 1,000? The balance 1,000 we have received as discount. It is our income, so should be credited to or added to the capital. So now our total transaction or new equation becomes cash of rupees 4,81,000, building of rupees 15 lakh, stock worth rupees 20,000, capital of 20 lakh and 1,000, and no creditors at all. Coming to last transaction students, depreciation on building. Now what does depreciation means? Depreciation means reduction in the value of assets because of its usage. We have used this building over a period of a number of years, so consequently there is wear and tear and everything. So there is a decline of rupees 20,000 on account of that usage. So now this is an expense. Because of regular usage, we can call it as an expense. Since it is an expense, it should be deducted out of capital. The second aspect is that the value of the building is reduced by 20,000 rupees. Now let us check and see what our new equation comes. Cash of 4,81,000, building is of 14,80,000, stock is worth rupees 20,000, the capital has a balance of 19,81,000 and no creditors at all. And it can be verified that the total on both the sides is same. Rules of debit and credit. Now students, these two terms, debit and credit, are used in accounts to show the two effects of a transaction. What do they show? They show two effects of a transaction. Now students, debit is in short written as DR and credit is written as CR. There are lots of theories and lots of interpretations of how these terms have actually come into being, but we will not go into the historical aspect of it. We'll just remember that debit and credit, they are the two terms which are used to show two different aspects of a transaction. Now students, in order to use debit and credit, we must understand the classification of accounts. So now, the next topic that we are going to start is classification of accounts. The accounts or the classification is actually on two bases now. There is a concept which we refer to as traditional classification. Traditional, and the other one is modern approach. Now students, under traditional classification, the accounts have been classified in two different categories. The first one being personal and the second one being impersonal. Impersonal accounts are further classified as real and nominal. So broadly, two categories, first personal, second is impersonal. Impersonal are further classified as real and nominal. Whereas under modern classification, there are 5 subcategories in which accounts have been divided. They are assets, liabilities, capital, revenue, and expenses. Now, we'll learn about how to classify accounts under all these categories and how to identify which account falls under which category. But we must remember that the rules of debit and credit or the increase and decrease actually depends upon which category a particular account falls under. Let us study about traditional classification of accounts in detail. Now, under traditional classification, any account can be broadly classified under two different categories. The first one being personal accounts. Now students, as the name suggests, personal accounts are accounts which relate to any individual. In any sense, if it is related to an individual, it would actually be a personal account. For example, debtors account, creditors account, they are individuals, so they are classified as personal accounts. They can carry a name, Ram, Shyam. Your bank account. Your bank account is actually run on your name, so it is your personal account. Similarly, the another category of accounts is impersonal. As the name suggests, they are not related to individuals. This category of accounts is further subdivided into two broad categories. They are real accounts and nominal accounts. Real accounts. Real accounts are accounts of assets. They generally relate to assets, cash, land, building, machinery. They are examples of real account. Nominal accounts. Nominal accounts are the accounts of income and expenses. Salary paid is an expense for the business. It is a nominal account. Interest paid is an expense for the business. It is a nominal account. Rent received is an income. It would be classified as a nominal account. So now students, we have two broad categories, personal accounts and impersonal accounts. Impersonal accounts are further classified as real and nominal. There are subcategories to all these accounts also. Let us understand them as well. Personal accounts can be further classified as artificial person account, They can be classified as natural personal account and representative personal account. Now students, artificial person accounts. Artificial persons are actually firms or entities which are run by individuals. Something like you are dealing with, let's say, Reliance Industries. For you, Reliance Industry would be an artificial person. All the rules would be applied as if it is a personal account. So since it is not a natural being, it would be categorized as an artificial person account. Similarly, natural person's account. Your debtors, your creditors. Let's say you purchase goods from Ram. So Ram is a natural person. His account would be a natural person's account under the category of personal accounts. Coming to representative personal accounts. So now what are representative personal accounts? Accounts like outstanding salary. Outstanding salary. Now students, salary per se is a nominal account because salary is an expense. But when we say outstanding salary, we relate to it to a person to whom salary has not yet been paid. As we relate it, it becomes a representative personal account. Coming to real accounts. Real accounts can be classified as tangible and intangible. Tangible are the ones which have physical existence, something like land, building, machinery. They can be touched, felt and seen. Whereas intangible accounts are the accounts which do not have physical existence. Something like your goodwill, it can only be felt. So now such kind of assets are classified as intangible fixed assets. So real accounts are further classified as tangible, the ones which have physical existence, can be touched, felt and seen, whereas intangible accounts which do not have physical existence. Nominal accounts, they are further classified as accounts of incomes and expenses. Expenses, the amounts that we spend to earn incomes. So both these accounts are covered under the category of nominal accounts. Coming to rules under traditional classification. Now students, rules of debit and credit under traditional classification. Now students, personal accounts. For personal accounts, the rules are debit the receiver and credit the giver. That means if the personal account is acting in a manner that it is receiving something, so it should be debited. And if the person is giving something, his account should be credited. Coming to real accounts. Real accounts are accounts which are related to assets. So either assets come in or go out. So rules are based as debit what comes in and credit what goes out. Now students, you must remember these key words here. The rules are based on what is coming in and what is going out. Debit what comes in, credit what goes out. For personal accounts, the keywords are receiver and giver. So debit the receiver, credit the giver. For nominal accounts, what are nominal accounts? Nominal accounts are accounts of income and expenses. So the rules are based on whether an item can be classified as an income or it is an expense. So the rule is debit all expenses and losses. It is the keyword here. And credit all incomes and gains. So now students, for nominal accounts, we must actually look for whether an item is an expense or a loss, or it is an income. If it is an expense, it should be debited, and if it is an income, it should be credited. We must all remember these rules by heart at any given moment of time if we actually wish to pass all the entries correctly. So now, just to reiterate, personal accounts, debit the receiver, credit the giver. Rules for real account: debit what comes in, credit what goes out. For nominal accounts, it is debit all expenses and losses, credit all incomes and gains. Under modern classification of accounts, the accounts can be classified under 5 basic categories. They are assets. We all know what are assets. Assets are things of value that a business owns, or they are the economic resources of an enterprise. For example, cash, building, machinery, they are all categorized as assets. The second classification is liabilities. The amounts payable by the business to outsiders is classified as liabilities. The third classification under the modern system is capital. Money invested by the owner in the business. Something which belongs to the owner, or the accounts which relate to the owner, are categorized under this classification. Next one being revenue. Accounts which relate to generation of income like sales, etc., are classified under this category. Then we have last one being expenses. The amount that a business spends to earn revenue are called as expenses. They are like salaries paid, interest paid, rent paid. They are all covered under the category of expenses. So now these are 5 broad categories: assets, liabilities, capital, revenue and expenses. Now students, the rules of debit and credit are based on these classifications. So let us understand them as well. Increase and decrease. Now students, if the assets increase, they are debited. The rule is, if there is an increase in asset, then they must be debited. Whereas if the assets decrease or their values decline, then they must be credited. Coming to liabilities. Liabilities are the amounts payable. Now students, if the liabilities increase, then they must be credited. And if there is a decrease in liability, then the liability account should be debited. So the rule for liabilities is, if there is an increase in liability, it must be credited, whereas any decrease in the amount of liability should be debited. Coming to capital. Now remember, capital is also a liability that the business has to pay, but it is payable to the owner. Or we can say that the owner is a creditor of the business to the extent of his capital. So since it can be classified as an internal liability, the rules are same. If there is an increase in capital, it must be credited, whereas any decrease must be debited. Coming to revenues, there are incomes. Any increase in the revenue should be credited, whereas any decrease should be debited. And it is exactly the opposite for expenses. Any increase in the expense should be debited, whereas any decrease in this amount should be credited. So now the rules are, for assets, any increase should be debited, decrease should be credited. For liabilities, it is the opposite: increase should be credited, decrease should be debited. For capital, increase credited and decrease debited. The same thing holds for revenue, but for expenses it is debit the increase and credit the decrease. Books of original entry. Now students, what are books of original entry? As the name suggests, these are books in which entry is recorded for the first time. Books in which entry of a transaction is recorded for the first time. Now students, how and what prompts an accountant to actually make an entry? Let us recall the process of accounting, and we had studied that for every transaction source documents are prepared. Source documents. Now students, if a transaction takes place, any voucher, bill or any transfer voucher is created. This document is then transferred to accountant, and upon receiving this source document, the accountant then makes an entry in the book. Makes an entry. Now students, we all know now that entry does not mean just writing like a paragraph. It means proper application of rules. So now this entry is made in a particular book which is referred to as journal. So the first principal book that we are going to do is journal. What is a journal? Students, journal can be classified as a book of original entry in which the entries are made in chronological order. The definition of journal is a book of original entry in which transactions are recorded in a chronological order. That is, as and when they occur. The entries that take place first up are recorded first up, and then the remaining transactions are recorded. Now students, how does a journal look like? There is a format to journal. The format is like this. It must be headed as journal. It has various columns to it. The leftmost column is the column for date. That is the date on which the transaction has taken place, for which the entry is being recorded here. The second column is particulars. Width wise, it is the largest column. It is the column in which actually the transactions are recorded. That is, after applying the rules, the accounts are then debited and credited. Then we have a small column for ledger folio, LF. LF I am writing here, it stands for ledger folio. Then there are two columns for amounts. One is debit and credit. The debit amounts would be recorded in the debit column and the credit amounts would be recorded in the credit column. Do not forget to mention the rupee sign here, since these are amounts. These are not just figures, these are amounts, so it must be mentioned with the sign of rupee. Now students, just to recall it, journal is a book of original entry in which all the transactions are recorded in chronological order. This is the format of journal. The left hand side is date, that is the date on which the transactions take place. Then we have particulars column. It is the largest column width wise in which actual transactions are recorded, that is the accounts to be debited and credited. Then we have ledger folio, that is to record account numbers and various other details. Debit and credit columns, these are two columns for amount in which the amounts to be debited and credited are recorded. Now journalize the following transactions. Now students, here we are going to understand how actually the entries are made. Now the first transaction here is received from Ram rupees 50,000. So now let us first of all analyze the kind of accounts that are involved here, their nature and how the rules would be applied. So for first transaction, received from Ram, what would we have received? We would have received cash. So one account involved here is cash account. Mind it, it is just your working here. We are receiving this cash from Ram. Now students, we must understand and analyze what is the nature of these two accounts. Cash is an asset, so it is a real account. Whereas Ram, it involves a name, it is a personal account. Now let us understand whether they would be debited and credited through traditional rules. Now students, under traditional system of accounting, personal account, the rule was debit the receiver, credit the giver. I just repeat, debit the receiver, credit the giver. So we are receiving from Ram, that means Ram is a giver. Ram is actually a giver. Since Ram is a giver, his account would be credited. Correspondingly, cash is a real account. The rule for real account is debit what comes in, credit what goes out. Since cash is coming into the business, since cash is coming in, it must be debited. So students, it is very clear that cash would be debited and Ram would be credited. So how this entry would be shown? It would be shown as Ram, it would be shown as cash account debited. The account which is debited is written on the top, and in front of that write DR. DR shows that this account has been debited to the credit account. That means the account which has been debited will appear on the top and the amount which has been credited will appear at the lower side of the transaction or the entry. Now students, cash account has been debited by rupees 50,000. So in front of cash account, in the debit column we will write 50,000, and in front of Ram, in the credit column we will write 50,000. We must make sure and we must verify also that the amount in the debit column is same as the amount in the credit column. So now students, what we did was we identified the accounts. The cash account and the Ram account were involved here. The cash account is a real account by nature and Ram account is a personal account by nature. By applying the rules, we found that Ram is giving, so he is a giver. The rule of personal account says that the giver should be credited. So Ram was credited and cash was coming in, so it should have been debited. So debited means cash account debited to Ram. Since the dates are not given, I'll just mention the serial number here. Now students, every entry or the journal entry that we have made has a narration part to it. The narration means it is actually a summary or it's an explanation of how and why this transaction has been made. It always starts from being. So we'll write being cash received from Ram. This line makes it clear that this entry was made because Ram has paid us certain sum of money. Now let us come to the second transaction. The second transaction is sold goods to Anand. Here we are selling goods and the goods are being sold to Anand. So for classification part, there are two accounts here. One is Anand, to whom we are selling, and the other account is sales account. Students, whenever goods are sold, sales account is used, and whenever goods are purchased, purchases account is used. So now in here, Anand is the name of an individual who is purchasing goods from us. Since he is purchasing goods from us, it is actually a personal account. By nature, it is a personal account. Sales, is an income for us. It should be classified as nominal account. Now students, the rule for personal accounts. The personal account rule is debit the receiver, credit the giver. According to this transaction, we are selling goods. That means Anand is receiving the goods. Since Anand is receiving the goods, Anand is a receiver and hence should be debited. So Anand should be debited because the rule clearly says debit the receiver. Whereas sales is an income for us. Since it is an income, the rule for nominal account says debit all expenses and losses, credit all incomes and gains. It is an income, so it should be credited. It should be credited. So now it is very clear that Anand would be debited and sales account would be credited. This entry number second would appear as the debit amount account on the top, that is Anand debited to sales account and the amount is 80,000. In front of Anand in the debit column 80,000 and in front of sales in the credit column 80,000. What about narration? This entry has been passed because goods have been sold to Anand. So we'll write being goods sold to Anand. Coming to the third transaction, students. The third transaction is purchased for cash. Obviously, what we'll purchase? If nothing is mentioned, it is purchase goods for cash. So we are purchasing goods. Whenever goods are purchased, it is the purchases account that is affected. And since it is being purchased for cash, the cash account has been affected. So the two accounts involved here are purchases account and the cash account. Purchases account is a nominal account. It's an expense. And the rule for nominal account is debit all expenses and losses. Since it is an expense, it should be debited. Coming to cash, cash is an asset. Since cash is an asset, it is a real account. And as per the rules of real account, debit what comes in, credit what goes out. Since we are purchasing, that means we are paying cash. That is, cash is going out. So according to rule, credit what goes out. So now it is clear that both the accounts, purchases and cash, out of these two, purchases would be debited and cash would be credited. So this entry would be written as purchases account debited to cash and amounts are 25,000 for debit and 25,000 for credit. The narration is being goods purchased for cash. So now students, it is very clear that we must first of all try and identify the two accounts that are involved, their nature, and then apply rules accordingly. The account that will be debited is written on the top and the account that is credited is written on the lower side of the transaction or the journal entry. The amount on the debit column should be corresponding to the debited account and vice versa for credit. At the last, we must total the journal so as to make sure that the amounts are equal, because debit and credit aspect should be equal. So here the total comes out to 1,55,000 rupees and it is equal on both the sides. So we must close it by making a double line at the bottom of the amounts column. Coming to some more examples about journal entries. Let us generalize these for given transactions. The first transaction here is paid rent rupees 20,000. Now again the same thing, students. We must analyze which two accounts are involved here. In this transaction, paid rent. So the first account is rent account. And since the payment has been made, the second account would automatically be cash account. Now students, rent is a nominal account. Rent is an expense. Since it is an expense, it is nominal by nature. Whereas cash is an asset, so it is a real account. Now let us apply rules for these two accounts. Nominal account. The rule for nominal accounts is debit all expenses and losses, credit all incomes and gains. Since it is an expense, it would be debit all expenses and losses. That means rent account would be debited. Coming to cash account, the rule for real account says debit what comes in, credit what goes out. Now since we are paying rent, cash is actually going out. Cash is going out, that means credit what goes out. So it is now clear that in this transaction, rent account is being debited and cash account is being credited. Again, the date is not mentioned, so I'll mention the serial number here. Rent account debited, the account which has been debited is written the first account, and to the account that has been credited, that is cash account. The amount is 20,000. Rent account debited, so the amount corresponding to this is written in the debit column. The cash account has been credited, so the amount corresponding to it should be written in the credit column. We must not forget narration as well. So the narration for this entry is being rent paid. Let us look at second transaction, students. The second transaction is paid salary by check rupees 15,000. That means the first account here is salary account. Since salary is being paid, but here the payment has been made by check. So the second account is bank account. Obviously, checks are drawn on bank, so it is bank account. So now students, we all understand salary is an expense for the business. Since it is an expense, it is a nominal account. Bank relates to individual, it is a personal account. Now let us apply rules for it. The rules for nominal account: debit all expenses and losses. So salary is an expense, so should be debited. Whereas coming to bank, personal account rules are debit the receiver, credit the giver. Now here the payment is being made through bank. Since the payment is made through bank, the bank is a giver. So credit the giver. So now we have salary account debited to bank account. Since salary is being debited, it should be written first account, salary account, in front of it debit to bank. And the amounts are 15,000 here, and in credit also 15,000. Narration. Narration is being salary paid by check. So students, salary account was debited, so it was written as salary debited to the account that was credited, which in this case is bank account. Now coming to the third transaction that we have, it says that purchase goods from Neeraj. Now here we have purchase goods from Neeraj. So the first account is Neeraj. There is no mention of cash, so Neeraj's account, personal account, would be involved here. And since we have purchased goods, whenever we purchase goods, it is the purchases account that is affected. Now, by nature, purchases is an expense, so a nominal account, whereas Neeraj is an individual, so his account can be classified as personal account. Now students, purchases is no nominal account, debit all expenses and losses. The rule is debit all expenses and losses, so it should be debited. Whereas Neeraj is the one who is actually a giver, because in personal accounts the keywords are giver and receiver. So let us recall the rules: debit the receiver, credit the giver. Since we are purchasing from Neeraj, Neeraj is actually a giver for us. He is a giver. Since he is a giver, this account must be credited. So students, the entry would appear as purchases account debited to Neeraj, and the amount would be 30,000 and 30,000 being purchased from Neeraj. And at the end, we must not forget to total out the trial balance. The total in this case comes to 65,000 on both the sides. Journalize the following transactions. Now students, the following transactions have taken place on these dates. So let us try and journalize them. The first transaction is paid rent by check. Now it involves two accounts. One is rent account, and since the payment has been made by check, the second account is bank account. Now students, rent is a nominal account. Since it is an expense, it is a nominal account. And the rule for nominal accounts is debit all expenses and losses, credit all incomes and gains. So since it is an expense, debit all expenses and losses. So rent account would be debited. And bank is a personal account. By applying the rules for personal account, we can say that it would be credited. So now rent is debited and bank is credited. So this entry would appear as rent account debited to bank account. Amount is rupees 10,000. Do mention the date here. 2011 is the year. January 2nd is the date. Narration: being rent paid by check. Now students, coming to the second transaction. The second transaction is on date of January 5th. It says that received interest rupees 5,000. Now there are two accounts. Received interest. Received means it must have been received in cash, and the second account is of interest. Cash is a real account. Interest is an income, so it is categorized as nominal account. Considering real accounts, the rules for real accounts are debit what comes in, credit what goes out. So here we have received. Since we have received, so the rules will say debit what comes in. So cash should be debited and interest is an income. So by applying the rules for nominal account, credit all incomes and gains. So the entry would now appear as cash account debited to interest. The amount would be 5,000. Do mention the date as well, January 5th, and the narration. The narration would be being interest received. Now students, coming to transaction on date number 8. It says that received cash 29,500 from Ram and discount allowed. Students, there are three accounts that are affected by this particular transaction. The first is cash account. Since we are receiving cash, obviously cash is being affected. Ram is paying us cash. So the second account is Ram. There is a third account involved, that is discount allowed. Discount allowed. Now considering the nature of these accounts, cash is a real account, Ram is a personal account, discount allowed is an expense, hence a nominal account. Let us apply rules to all these three accounts. Cash, it's a real account. The rule is debit what comes in, credit what goes out. So now since we are receiving cash, debit what comes in. Cash is debited. Ram is giving us this amount of cash. So according to the personal account rules, debit what comes in, debit the receiver, credit the giver. So this would be a giver, hence credited. Whereas discount allowed is a nominal account. Nominal account is debit all expenses and losses. So in this particular transaction, there are two accounts that are debited, cash and discount allowed, and Ram is the only account that should be credited. So let's see how we'll actually present this particular transaction. Cash account debited, discount allowed account debited, to Ram. That means all the accounts that are debited are shown together to the particular account that has been credited. Cash has been received to the extent of 29,500 rupees. We have allowed a discount of rupees 500. That is also in the debit column. That means Ram had to pay us 30,000 rupees. Make sure that the debit aspect and the credit aspect are equal. Do mention the date, that is January 8th, and narration. Being cash received and discount allowed. And at the end, do make sure to total out the trial balance and verify that they are equal. This is 45,000 on the credit side and 45,000 on the debit side. Now let us understand how we can journalize the transactions using modern classification of accounting. Now students, just to recall, under modern classification, there are 5 categories in which an account can be classified. They are assets, liabilities, revenue, expenses, and capital. So now let us use that particular classification for journalizing these entries. Now entry on March 12 says salaries paid rupees 20,000. Now students, there are two accounts involved here, cash and salary. Cash is an asset, so it is under the category of assets. Salary is an expense, so classified as expenses. Now students, let us recall rules for assets. Whenever there is an increase in asset, it should be debited, and whenever there is a decrease in asset, it should be credited. In this case, since we are paying, that means cash is going out. There is a decrease in cash, so this should be credited. For expenses, the rules are debit if the expenses increase and credit if they decrease. Here we are paying, that means expenses are increasing. So salary account should be debited. So the entry would appear as salary account debited to cash account 20,000 rupees, 20,000 here. Everything else remains same. Only thing is that the rules will be applied in a different manner. Narration being salary paid. And do mention the date as well, March 12th. Now students, coming to the second transaction that is given to us, that is on date March 20th. It says rent outstanding 10,000. Now there are two accounts involved here. First one being rent outstanding account and the second account being rent account. Now students, rent outstanding means the rent has not yet been paid. So it will come under the category of liabilities. And rent is an expense, so categorized under the expenses classification. Now students, rules for liabilities. The rules for liabilities are debit if the liabilities increase and credit if they increase. In this case, liabilities are increasing, so it should be credited. Whereas for expenses, the rules are debit if the expenses increase, whereas they should be credited if they decrease. In this case, we are paying, so our expenses are increasing, rent account should be debited. So the entry would be rent account debited to rent outstanding account. Narration being rent due. Date would be March 20th and the amounts are 10,000 in debit and credit. Now coming to the transaction that is mentioned on the board for date 21st March. It says purchase building for rupees 25 lakh for cash. Now the two accounts involved here are building account and cash account. Building is an asset and cash is also an asset. So now the rules for assets are debit if the assets increase and credit if they decrease. We are purchasing building, so it is increasing, hence should be debited. We are paying cash, the value of cash or the cash in hand is decreasing, so it should be credited. So the entry would appear as building account debited to cash account being building purchased. Date is March 21st and the amount is 25 lakhs on both the sides, that is debit and credit. Do total it out and the total is 25 lakh 30,000 on both the sides. So now students, you must analyze and understand this thing also, that whether we use modern classification or we use the traditional classification, the end result, that is the journal entry, would be same. The same account salary would be debited in both the cases, whatever classification you choose, and the same account cash would be credited whatever classification is chosen by you. Journalize the following transactions. Now the first transaction is received 24,500 from Neeraj and discount received rupees 500. Now students, there are three accounts involved in this: Neeraj, cash and discount received. Neeraj, since Neeraj is getting payment from us, that means we had to pay him something. So he was under the category of liabilities. Cash is an asset and discount received is our income, or under the categories of revenue. Now students, applying the rules, liabilities. If the liabilities are increasing, they should be credited, and if they are decreasing, they should be debited. Now in this case, the payment is being made to Neeraj. That means liabilities are decreasing. So hence debit. Cash is an asset. For asset, if the assets are decreasing, they should be credited. Since we are paying cash, so cash is decreasing. Coming to revenue, revenue we are receiving something. Since it is increasing, it becomes our income, it should be credited. So now students, the entry would appear as Neeraj debited to cash to discount received. Cash paid was 24,500 and discount received was 500. So in total, Neeraj account would be debited by 25,000. Again, make sure that in such entries, debit and credit, both aspects are equal. Narration being payment made to Neeraj and discount received. There is no date, so we will mention serial number here. Now students, coming to the second transaction. The second transaction is withdrawn by owner cash worth rupees 5,000. Now since owner is withdrawing cash, so one account is cash and the second account is drawings. Any amount withdrawn by owner is categorized as drawings. Now students, under classification, cash is an asset and drawings will come under the classification of capital. Applying rules, since cash is decreasing, so any decrease in asset should be credited and correspondingly this account would be debited. So entry would appear as drawings debited to cash account, being amount withdrawn, and it is 5,000. Now students, since for capital the rule is if the capital increase it should be credited, otherwise it should be debited. So in this case, since owner is withdrawing, his liability is reduced to that extent. So that means the liability is decreasing, hence debited. Now coming to the third transaction. Goods worth rupees 5,000 given in charity. There is a charity account involved here and goods. Now students, remember, when we sell goods, it is the sales account that is involved. But when goods are given out, not considering that it is a sale. Let's take an example. You give goods in charity. It cannot be classified as sale. So then which account is involved here? It is the purchases account. In any case where goods are going out of the business and they are not being sold, so they should be taken out of purchases account. Now charity is an expense and purchases is also under the category of expenses. Now students, when the expenses increase, they should be debited, so charity should be debited and correspondingly purchases would be credited. So the entry would appear as charity account debited to purchases account and the amount would be 5,000. This is transaction number 3. Narration would be being goods given in charity. Now students, you must always remember that in such entries, the recording is always done at cost. That is, if both the cost and the sale price are given to you, these entries would always be recorded at their cost. Ledger. Ledger is a book of principal entry in which accounting entries related to an account are recorded. Now students, remember it is a principal book where entries related to an account are recorded. Now students, remember it is a principal book, but it is a book of secondary entry. Secondary entry. The book of primary entry is journal, wherein the entries are recorded first up, and from journal then entries are transferred to particular ledger account. Now students, you must remember this thing, that ledger performs the function of classification, that is classification. Let us recall, we had done this in previous sessions, that accounting performs various functions. What are those functions? The first of those functions was recording. That is, the transactions are recorded. This function is performed by journal, wherein all the transactions are recorded by duly applying the rules of debit and credit. The second function was classification. This function is performed by ledger. What ledger does is that it collects various entries from the journal related to a particular account and presents a meaningful result. So now ledger performs the function of classification. Let us have a look on the format of ledger. The ledger is divided from the center into two parts. The left side is the debit side and the right side is the credit side. Each side has a column for date, particulars, JF. JF stands for journal folio, and amount. Similarly, on the credit side, we have date, particulars, journal folio, and amount. And it must be titled, that is, the name of the account should be written at the top, name of account. Just to reiterate students, a ledger is divided from the center into two parts. The left hand side is the debit side and the right hand side is the credit side. Each side has four columns: date, particulars, journal folio and amount. In ledger we have journal folio, but in journal, just to recall, if you recall, we have ledger folio, because in ledger the entries are recorded as onto what page of journal they are appearing, but in journal the account number or the ledger number is recorded. So it's the other way around. In journal it is ledger folio, whereas in ledger it is journal folio. Let us understand the distinction between the journal and the ledger. Journal and ledger. Now students, journal is a book of principal entry. It is a book of principal entry. That is, every transaction is recorded first up in the journal, and ledger is the book of secondary entry. Then students, in journal the entries are recorded in chronological order. whereas ledger is used for analytical purposes. Then in journal, whenever we pass an entry, it is called as journalizing. Whereas in ledger, the process of transfer of entries is called as postings. And at last, student, journal performs the function of recording, whereas a ledger performs the function of classification. Let us learn how to make postings from journal entries. Now students, here on board I have written two journal entries. The first journal entry is RAM to sales and the second one is cash to RAM. Now we will learn what would be the effect and how would they be transferred to various ledger accounts. Now student, let us concentrate on the first entry. In first entry there are two accounts involved, that is RAM and sales. Now students, in this entry, RAM account has been debited and sales account has been credited. So the two accounts that are affected are RAM and sales. So let us make two different ledger accounts. The first one being sales account and the second being RAM. Now student, in this entry, RAM is being debited. So while making the posting, we must consider and we must make sure that the account which has been debited, the postings will be made on the debit side, and the debit side is the left hand side. And the account which has been credited, in this case this is sales account. So in sales account, the entry would be made on the credit side. I'll just repeat it. The account which has been debited, the entries would be made on the debit side, and the accounts which are credited, in those accounts the postings will be made on the credit side. Now student, RAM account debited. Let's see how this will appear. So on the debit side of RAM, you will write to sales account. RAM account debited to sales. That completes the entry. Again, the account which has been debited, the entry will appear on the debit side, but the name will appear of the second account. In this case, it was sales account. Amount would be 20,000. Now student, just remember, every entry that is made on the debit side is preceded by 2. Now coming to the second effect of this transaction. The second account that has been affected in this transaction is sales account. We have sales account here. Now sales account has been credited. So this posting will appear on the credit side of the sales account. On the credit side is the right hand side. So every entry on the credit side is preceded by the name of the other account, RAM. That means sales account was credited by RAM. As is clear from this entry, sales account is credited by RAM. Amount 20,000. Both the effects have been shown. The account which was debited, that is RAM, the posting has appeared on the debit side, but the name is of sales account. Whereas sales account was credited, so the posting has appeared on the credit side of the sales account as it has been credited by RAM. Just remember that there is a cross entry. Cross entry means, I am highlighting it using this arrow. An entry on the credit side of one account is corresponded by an entry on the debit side of the other account. Now students, let us try and post the second journal entry. Cash account debited to RAM. In this case, cash account has been debited. So we don't have a cash account, so let us prepare cash account. This is our cash account. Now cash account has been debited. Again, the account which has been debited, the posting will appear on the debit side. So on the debit side of cash account, we'll write to Ram, amount 20,000 rupees. Again, the same process should be repeated for Ram. Ram's account has been credited. Since Ram's account has been credited, that means the entry will appear on the credit side, and the credit side is the right hand side. So on the credit side of Ram, we'll write by cash, as it was credited by cash. So the amount would be 20,000. Make sure that you are writing the dates as well. So in first case, the date was January 1st, January 1, and in second case it was January 3rd. Again, the same thing you must verify. There is a cross entry. An entry on the debit side of one account is matched by the entry on the credit side of another account. Let us post these journal entries into ledger accounts. Now students, there are two entries written here. On June 20th, there is an entry of cash to sales. That is goods sold for cash. Now in this case, there are two accounts that are affected. The first one being cash and the second one being sales. So let us prepare cash account. Let's say this is our cash account and this is our sales account. Now students, in this entry, cash account has been debited. Since the cash account has been debited, this entry would be posted onto the debit side of cash account. That is, the account which has been debited, the posting is made on the debit side, and the account which has been credited, the posting would be made on the credit side. So now in this case, cash account is being debited. So June 20th is the date, and on the debit side of cash account, we'll write to sales. Cash has been debited for sales account. Amount would be 1 lakh rupees. Now students, coming to sales account. In this entry, the sales account has been credited. So the entry would be made on the credit side of sales account. Now credit side is the right hand side. So on sales account, on the credit side, June 20th is the date, by. Every entry on the credit side is preceded by So this account was credited by cash account. So we'll write by cash account and the amount would be 1 lakh rupees. Again, we must make sure that there is a cross entry. Cross entry means an entry on the debit side of one account is matched by an entry on the credit side of the other account. So in one account debit and in other account credit. Coming to the second transaction, the date is June 25th. Cash to Vijay. That means we have received cash from Vijay. In this entry, cash account is debited. So again, on the debit of cash account, we'll write to Vijay. Since the cash account was debit, the entry would be made on the debit side of cash account to Vijay 80,000 and date is June 25th. The second account in this case is Vijay. So let us open a ledger account for Vijay. This is the ledger account for Vijay. In case of Vijay, Vijay has been credited. So the entry would be made on the credit side. That is the right hand side of the account. Date is June 25th by. This account was credited by cash. So by cash account 80,000. Now students, again we can see very clearly that an entry on the debit side has been matched by an entry on the credit side of this account. So now it again illustrates the double entry concept, that is one aspect, that is debit aspect, and the other aspect, credit aspect, both are equal and both are recorded.